One of my coworkers here in Orlando is an fund manager, asset manager in my firm. Had a 7, 8, 9-year-old daughter at the time, and she was going to school, and the nosy teacher in show and tell asked the daughter, "What does your dad do for a living?" And the girl said, "Well, my dad plays Monopoly, but with real money."
Yep.
That's as close as it gets to what we're doing. The two exceptions are we don't play with the money, and it's not our money, it's other people's money.
Mm-hmm.
To give you an idea, a typical fund for us is 10 investors, all institutional investors, putting up 50 million each, gives you 500 million in equity. You put another 500 million in debt on top of it, and you, bingo, have $1 billion fund.
Mm-hmm.
So then you have a club deal type of atmosphere where the investors know each other in the fund. It's limited to 10 to 15.
Okay.
Anything beyond that, and can't call it a club deal anymore. There are funds, especially the Blackstones, the true private equity firms that have hundreds of investors. But our deals are normally club deals, 500 million to $1 billion, maybe a little bit more.
So walk me through the development of a fund, both in terms of the places where you seek opportunity, the places where you look for opportunity seekers, the people whose money you're going to be investing, how you pitch to them.
Okay, perfect. The life of a fund. Part 1, idea generation, capital raising.
Mm-hmm.
Phase 2 is then the investment phase, the portfolio optimization phase, also called the holding phase, and finally liquidation.
Right.
Let's start with phase 2. Most of these commingled closed-end funds are finite life, and the finite life is almost all the time, 9 out of 10 times, a 10-year term.
Right.
In that you have, on average, 2 years of acquisition investment to build the portfolio. Then you have roughly 5 years, from years 3 to year 8 or so, of optimizing and asset managing the portfolio, getting the optimum value for the portfolio. And then you have 1 to 2 years of liquidation.
Okay.
So that's the easy part. The part before that, idea generation, concept development, capital raising, from the moment somebody comes to senior management and says, "I have an idea for a new fund. There is a window of opportunity in America right now," or something. From that moment on to having the capital raised, how long do you think that takes?
Oh, probably 18 months to 2 years.
Yeah, you're close. I have a timeline for this. If it's a brand new fund, it'll take 24 to 36 months.
Right.
The capital raising part is about 1 to 2 years of that, but it is easily 1 to 1.5 years of work to get the fund to the point where you can raise the capital.
So when we talk about a 10-year fund, we're not saying that these assets are held for 10 years. That's the whole life of the project, so to speak.
If it's a 10-year finite life fund, then the assets are held from the moment they are acquired, which is during the first 2 years.
Right.
So they are on average probably held for 8 to 9 years.
Okay.
What do you do if the liquidation phase happens to be, like in our first flagship fund in 2012? Because we started our first fund in 2001 or 2002. At 10 years, when you get to the middle of the last financial crisis. Was that a good time to liquidate assets? No, it was not. So we went back to the investors and said, "Hey, this is not the best time to liquidate." And they gave us 3 more years.
Okay.
So 2012 plus 3, so it's 2015. And we are right now liquidating the last of the assets.
Oh, well, that's good. Good timing.
Well, it has worked out. It has worked out well for the investors and for GLL. what you have to create in fund management, one of the cardinal sins, if you don't do it, you have to create no conflicts of interest between the general partner and the limited partners. Everybody needs to pull on the same string, and the fund manager must have the same incentive as the investors to sell at the best point in time.
Right.
We keep it fairly simple. It's basically the fund manager gets 20% of the appreciation.
Mm-hmm.
So you have $1 billion fund. If that in 10 years grows to $2 billion, let's say 1.5 billion.
That's a pretty good growth.
Well, 1.5 billion,
Okay.
you have a 500 million capital gain.
Sure.
20% of that is 100 million
Right.
for the fund manager.
Mm-hmm.
That goes into the bonus pool, profit distribution, and pays for all kinds of things. So, yeah, that's why you really want to be part of this industry.
Talk to me about the process of going out, raising the capital, who you talk to, and specifically how over the years you have learned to tailor your presentation to the kind of metrics and polish that they want.
It's a wide open field. I don't even know where to start. Let me put it this way. We have learned over the years that you should create as homogeneous an investor pool as possible. Ideally, 10 pension funds from the same country that have the same tax regime, the same currency exposure. You can mix and match pension funds and other institutions such as insurance companies, but you cannot probably put family offices or so in there. They have different return expectations and investment goals.
Right.
So that's the first thing. You create a homogeneous pool of investors. Otherwise, it's going to be a disaster. You have to make a determination early on whether fundraising is part of your core competence in your own company, or whether you want to farm out the fundraising.
Okay.
That can be done today, and there are specialist firms that probably originated on Wall Street. They're called placement agents. And for a fee, say anywhere between 1% and 5% of the equity raised, they will do it. You can mix and match. You can say, hey, I know the German institutional investors. I know everyone there. I'll do that myself. But I don't know the Asian or Middle Eastern investors.
So they don't stipulate that it's all or none. They'll do whatever you ask.
No, you can have different placement agents in different regions.
Okay. I'm interested, and this is entirely tangential, really, to the interview. But what is your experience like raising capital in Germany? I just imagine the risk tolerance is very different, and maybe it isn't, but
it is. You put your finger right on it. Our investors are institutions. They are insurance companies. They are pension funds. They have a very low risk tolerance. That's why we tend to offer the safest, most core type of investment funds. We have ventured outside the core area, but we are really known as a core fund manager.
Okay.
Because that's the nature of our capital.
Right. Our
investors tend to be happy in today's environment, which is a very low interest and low cap rate environment.
Right.
They're getting on an annual basis maybe 5%, on a total return basis maybe 7%. And they have to compare that to less than 1% they're getting on German fixed income. German bonds just went negative. So why would they invest? They have these pension funds traditionally have 60% of their portfolio in gilts or German bonds. 10-year German treasuries. And that's not a win situation for them.
Right.
So if we can deliver 4 or 5% or 6% to them,
it's exponentially higher.
So the capital raising environment right now is good
Mm-hmm.
because institutions are allocating more to real estate than they have in the past.
How long, in terms of maybe half-decade increments, do you think that these very low interest rates? I mean, in Europe sometimes it's negative, but in the States it's also pretty low. Is that a 5, 10, 15, 20-year reality? What's your guess?
If I knew the answer,
Yeah.
I would be sitting here. I would be investing. It is an aberration what we have. The average 10-year treasury in the US over the last 30 years, forget the last 5 years of low interest, is probably 6 to 7%.
Mm-hmm.
And we're now at 1.5% 10-year treasury yield. That is manufactured by the Federal Reserve banks of this world.
Mm-hmm.
It is an aberration and it's not normal.
Mm-hmm.
It is the one big question that overhangs all of the discussions at real estate conferences and what have you. When will it end? I do not have the answer. I will tell you that I privately have bet the last 3 years against the Fed, and I've lost a lot of money.
Mm-hmm.
So I'm not the right person to ask.
One of the things that interests me the most is the way that we all get specialized. I've talked to developers about, well, why are you a developer? Why didn't you do private equity? And I've talked to private equity people. Why didn't you do development? And the best advice I've heard is that really it's a market cycle thing. There are times when you could build brand new stuff for basically the same price or even less than you could buy stuff that's already established. But there are other times when it just doesn't make any sense to build anything. And there the whole metaphor of a used car comes in. Why buy something? Why build something new? You can buy it just off the lot and it's 25% cheaper. But it does seem to be a market cycle thing. Like at certain times in the market, it's better to buy. At certain times, it's better to build. But then you have the problem that you specialize in one or the other. Even though it would, on paper, be better to develop at this point or buy at this point, you specialize. You're a developer or you're private equity. Have there been many instances when you felt like, well, if all things were equal, I would rather be developing right now, but I'm in the buying business?
There have been instances, not many, but there have been. We are not developers.
Right.
We have developed some in Eastern Europe,
Right.
but not in the United States. But we had a wonderful opportunity in San Francisco, 350 Mission. The building was to be torn down, 4-story or 5-story, 80, 90-year-old building. Right in the center of development, the financial district was moving south right into that area. We had more than a half a year of discussion about whether we should develop this. We had the rights, we had the air rights, we had everything ready to go.
All teed up.
All teed up. And in the end, we decided not to do it. We learned something about our firm, which is very important. We learned that our company does not have the developer gene. You have to have that gene. It's a development is risk-taking and is more art than science.
Mm-hmm.
We're more science guys. We're more numbers guys.
Mm-hmm.
I would have put my own money easily into that development. Well, we sold the whole thing ready to go, shovel ready, to a local developer. Made a tidy profit by just holding
Yep.
and selling. Let's say it was a 2-base hit. It was not a grand slam.
Yep.
The developer bought it and within 2 months had secured a 15-year lease for the whole building, build new, spec building.
Yep.
New. That is what a grand slam is. So, yeah.
So it's a risk that everybody deals with.
It is a risk, and has it been tempting? Yes, but we're doing well, and we should maybe not get too greedy.